In this video, we're going to record sales transactions under a perpetual inventory system. Good Deal uses a perpetual inventory system, and the following activities occurred during March. For each transaction, we're asked to prepare a journal entry and ensure our basic accounting equation balances. We're told that on March 3rd, Good Deal sold inventory that cost $4,000 for $7,000 on account. Keep in mind that that word on account means that we're going to get paid later. No cash exchanges hands today. So the first thing we want to do is we want to record the sale part of the transaction. And that sale part of the transaction involves an increase in assets, accounts receivable. The customer owes us $7,000. And of course, we've provided a service or delivered goods. We've made a sale of $7,000. So we have an increase in revenues of $7,000, which will of course increase stockholders' equity. That's half the transaction. The other half of the transaction is we need to decrease inventory for $4,000. That inventory cost us $4,000 and we no longer have it. So we're going to decrease an asset, inventory, for $4,000. And the matching principle says we want to match that cost with the revenues it generated. So at the same time, we're going to record cost of goods sold, an expense, which will decrease stockholders' equity. So in terms of our sales transactions, we have an increase in accounts receivable, a debit to accounts receivable of $7,000. We increase revenues as well as equity with credits, so we have a $7,000 credit to sales. In terms of inventory and cost of goods sold, we increase expenses with debits, so we debit cost of goods sold for $4,000. And we decrease assets with credits, so we credit inventory for $4,000. Next, we're told that on March 23rd, a customer returns $1,000 worth of merchandise. The inventory had cost Good Deal $700, and the inventory is undamaged and can be returned to inventory. So if the customer has returned $1,000 worth of inventory, we need to reduce accounts receivable for $1,000. In other words, we're going to what we call credit their account, correct? So they don't owe us $1,000. And of course, we need to record a reduction in sales. But rather than recording a direct reduction in sales, we're going to use a contra account called sales returns and allowances. And as we record a sales returns and allowance, that will reduce sales and reduce stockholders' equity. At the same time, they've given us back inventory that we can put back into stock. And because it's undamaged and we can put it back into stock, we will increase inventory by $700. And we will reduce our cost of goods sold associated with the sale by that same $700. Of course, if the inventory was damaged and couldn't be resold, we wouldn't have this second part of the entry. All right, let's take a look at our journal entries. First thing we got going on is we're going to reduce sales or reduce an equity account by debiting our sales returns and allowances for $1,000. And we had to reduce an asset, accounts receivable, and we reduce assets with credits for $1,000. We've increased an asset, inventory, so we will debit inventory for $700. And we reduced an expense, and we reduce expenses with credits, so we credit cost of goods sold for $700. Finally, we're told that Good Deal's customer pays for the remaining merchandise on March 29. So originally, we had accounts receivable of $7,000. They returned $1,000 worth of merchandise. So at this point in time, they owe us $6,000. So if they pay for that, we get an increase in cash of $6,000. And of course, at the same time, we will decrease accounts receivable by $6,000. Notice, nothing's going on with our income statement at this point in time. We record the sale transaction at the time the goods are delivered, not when the cash is received. So we've got an increase in cash, a $6,000 debit to cash, and a $6,000 credit to reduce our accounts receivable. All right, now we're going to take a look at sales transactions with sales discounts. Again, Good Deal uses a perpetual inventory system, and the following activities occurred during March. And we're asked to prepare transactions and journal entries to ensure our basic accounting equation remains in balance. On March 3rd, Good Deal sold inventory costing $5,000 to Jasper for $8,000, terms 310 net 30. So again, the terms 310 net 30 means we will get or give our customer a 3% discount if they pay within 10 days. Otherwise, they owe the full amount or remaining balance in 30 days. So we made a sale for $8,000 to Jasper, and the inventory cost us $5,000. It's on account, so we have an increase in accounts receivable of $8,000. And again, we're going to record the sales of $8,000 with a increase to sales revenue, which will increase net income, which increases stockholders' equity or shareholders' equity by that same $8,000. We've got a decrease in inventory. We've shipped them off $5,000 worth of inventory. And the matching principle says we want to record that cost as an expense in the same period as a sale. So we record an expense, cost of goods sold, which will decrease stockholders' equity. In terms of our journal entries, let's record the sales part of the transaction first. Again, we increase assets with debits, so we debit accounts receivable for $8,000, and we have that offset with a credit to sales of $8,000. Inventory and cost of goods sold. We increase cost of goods sold or expenses with debits, and we decrease the inventory and asset with a credit to inventory of $5,000. Next, we're told that Good Deal's customer, Jastomer, pays for half of the merchandise on March 6th, taking advantage of the sales discount. And again, the discount is 3% of the amount paid within the discount period. Jasper is paying for half the purchase, or $4,000, within that 10 days, and will be entitled to a $120 discount. So let's take a look and see what's happening on our accounting equation. First thing, we will receive $3,880 in cash. That's the $4,000 less the discount. We're going to want to reduce accounts receivable by $4,000 because Jasper, they've paid us within that 10 days. They're going to expect their bill to go down by half. And yet we've only received $3,880 in cash. So obviously with our journal entries right now, or our accounting equation, debits don't equal credits. So we need to credit an equity account. We will credit sales discount, a contra account to sales. In other words, we're really pretending that we didn't have $4,000 worth of sales. We had $3,880 worth of sales, at least as it relates to this half of the sales. In terms of our journal entries, we got $3,880 in cash, which we record with a debit to cash. We had a debit to sales discounts. Again, we have a reduction in equity, so we record that sales discount with a debit of $120. And we reduce our accounts receivable by $4,000 with a credit to receivables of $4,000. So if we look at our T account right now for accounts receivable, recall we began with our original sale of $8,000. They have only paid us $3,880, but because they paid within the discount period, we gave them credit for a full $4,000. So the current remaining balance in receivables is $4,000. And we're told that Jasper pays for the rest of the merchandise on April 1st. So on April 1st, it's outside the discount period, so we're going to expect to get $4,000 in cash. So we have an increase in assets of $4,000 and a decrease in accounts receivable of $4,000. We record that increase in assets or cash with a debit to cash of $4,000, the decrease in receivables with a credit to accounts receivable of $4,000. Let's go ahead and take a look at Good Deal's gross profit as well as its gross profit margin, both with the sales discount and without the discounts. So if there hadn't been a sales discount, with no sales discount, our gross profit would have been $3,000. Again, that was our original selling price of $8,000 minus the $5,000 cost of inventory. So we would have had a gross profit of $3,000. And $3,000 gross profit on $8,000 in sales means we would have had a gross profit margin of 37.5%. Now, with the discounts, however, our gross profit margin goes down, as does our net sales. Our gross profit margin would have only been $2,280. And of course, our gross profit margin would have also gone down. And notice we calculate that gross profit by taking sales of 8,000, subtracting any sales returns, which we didn't have in this case, subtracting any sales discounts. We had 120 in discounts, so net sales were $7,880. So our gross profit then is net sales of $7,880 minus $5,000 in cost of goods sold, or $2,880. Our gross profit margin is that gross profit of $2,880 divided by $7,880 in net sales, and our gross profit is 36.5%. So notice, when we offer our customers discounts for paying early, we get the cash sooner, we accelerate collections, but it reduces our overall profit margins.